Our first example looks at the timing of collections for receivables. We have 4 months worth of sales forecasts in which the sales have been broken down into cash sales and credit sales. And for credit sales, we have the following collections schedule, and the idea being that 40% of credit sales are collected in the month of the sale, 50% in the month following the sale, and 5% 2 months following the sale. That leaves 5% as uncollectible. It is always important when doing a cash budget to make sure you get the timing correct. So let's look at January sales, and we'll do a bit of a flow chart just to make sure we understand when we expect the cash to come in. So initially there are $50,000 of cash sales, and those will be collected in January, and $160,000 in credit sales. Now we'll have to look at when we expect the $160,000 to be collected. The $160,000 will be divided up 40% collected in the current period, or $64,000, 50% collected 1 month later in February, or $80,000, and 5% collected 2 months later in March, $8,000. Now let's schedule the cash collections in March. These collections will start with credit sales in January of $160,000, but by the time we get to March, only 5% remains to be collected, so that's $8,000. Now the credit sales in February will have 50% collected in March, and that's equal to $88,000. The credit sales in March, 40% are collected in March, $77,200. And of course, we don't want to forget the actual cash sales in March, so we'll add those in, $70,000. So the total in March is equal to $243,200. Another type of budget is the inventory budget. It's often important to schedule the acquisition of inventory, since that will be an important factor determining the amount of cash outflow. A couple of things to notice are the assumption that cost of goods sold equals 60% of sales in any given month, and that the company expects to have on hand at the beginning of each month inventory equal to 30% of its needs for the month. We're now asked to determine the inventory purchases for January. Before we start, let's think a little bit about how we're going to solve this problem. Well, the inventory here is the finished goods inventory, and what we're going to need are the beginning balance, the ending balance, the cost of goods sold, and ultimately what we want to do is determine the purchases. Now let's see if we can determine what some of those values are going to be. Well, the sales forecast says that in January a total of $210,000 of sales are expected, and that cost of goods sold is equal to 60% of sales. So 60% of $210,000 gets us to $126,000. And of course we want to have 30% of that on hand at the beginning of the period. So 30% of $126,000 tells us that we need to have a beginning inventory at cost of $37,800. On the last slide, we determined that the beginning balance in the finished goods inventory would be $37,800, That cost of goods sold would be $126,000. Next, we need to determine what the ending balance will be. Well, the ending balance in January is equal to the beginning balance in February, so we'll look at February sales. February sales are equal to $236,000. 60% of that equals the cost of goods sold for February, and of course we want 30% on hand. So 30% of $141,600 gives us a beginning balance in February of $42,480, and that will be our ending balance for the January inventory. Now that we have all the pieces in place, let's just put it together. So the finished goods inventory in January has a beginning balance of $37,800, cost of goods sold $126,000, and the ending balance taken from the beginning balance in February, $42,800. Therefore, the amount of purchases required equals $130,600. All that remains is to schedule out the collections. We're now going to try to determine the cash payment for February. This is a rather involved calculation since we're going to have to work through the inventory for February, but of course this requires that we also work through at least partially the inventory for March. Ultimately, what we need is the amount of February purchases. To calculate the cash payments for February, we're going to need the purchases in January that we calculated earlier, plus the purchases in February. To get the February purchases, we start with the beginning balance in the inventory that we calculated before. Then we calculate the cost of goods sold, which are the sales times 60%, and that's going to work out to $141,600. Now we need to calculate the ending balance. So to get that, we look at the March sales, and we multiply that by 60% and then by 30%, and that gets us to the beginning balance in March or the ending balance in February. The only thing that remains then is to balance the account, and we do that. It turns out that $146,568 equals the February purchases. Now that we have the purchase schedule, we can now look at the cash payment schedule. The January purchases are 60% paid in January and 40% paid in February, while the February purchases are 60% paid in February. When we work those numbers out, the cash out in February from January purchases is $52,272, and the cash out in February from February purchases, $87,995. So the total cash out in February is $140,267. Our next problem is to look at a reduced version of a master budget. The master budget can include essentially all of the forecasted financial statements and can be a very extensive exercise. We're just going to look at some of the basic logic of preparing a master budget. Most budgets start with a budget for sales, and we can see that provided in the problem. We also have budgets for beginning and ending inventory of finished goods and also for raw material. Finally, we have some data here on the inputs used for our two products. These are direct materials and direct labor. Now, budgets tend to go from the top down, and we will work through this analysis. Let's consider what has to happen if we're going to produce 1 unit of a product called Z's. Well, that unit has to come from somewhere. Well, it comes from work in process. And according to our data, in order to make 1 Z, we're going to need 1 hour of labor, and that labor is going to cost us $30. The Z is also going to require 3 pounds of materials, and those materials are going to come from the raw materials inventory. However, Just because we use 3 pounds of materials doesn't mean we have to purchase 3 pounds of materials. In order to determine how much is going to be purchased, we will need to work through the raw materials inventory based on our forecast for beginning and ending inventory. We also note that any purchases of raw materials will be at $8 per pound. So we start the process by looking at the sales for the 2 products and also for the levels of inventory at the beginning and end. We then take the 2 products, the Z's, and we put in the information regarding the beginning inventory, the ending inventory, and the sales, which are 8,000 for the Z's and 10,000 for the X's. Once we have this information, we can determine a production schedule of 7,000 Z's and 11,000 X's. Turning our attention to the material requirements in order to make 11,000 X's and 7,000 Z's, we take the beginning and ending inventories that we are scheduling for raw materials, and we add that to the raw material account, 5,000 units and 4,000 units. And then we consider what the production requirements are. Well, to make 11,000 X's, and each X uses 2 pounds of materials, so 11,000 times 2 is equal to 22,000 pounds of materials, and as you can see, that's going to be a credit to the raw materials. Now if we look at the Z's, we're going to produce 7,000 units. Each Z uses 3 pounds, so we get 21,000 pounds of materials that we expect to use in production. And now we're set up to determine what the material purchases are. Well, in order to balance the account, we need to purchase 42,000 pounds of materials. Now materials cost $8 a pound, so we take the amount of materials that we plan to purchase times the budgeted price, and that allows us to determine the materials purchases budget. The labor calculation is similar, except of course you can't inventory labor, so the calculation is somewhat easier. We start with the production requirement budgets of 11,000 X's and 7,000 Z's. We then see that each X requires half an hour of labor and each Z 1 hour of labor. So we take 11,000 times a half hour and get 5,500 hours for the production of X's. And for Z's, 7,000 times 1 hour, or 7,000 labor hours. Add everything up, and the total budget for labor is 12,500 hours. Multiply that by the forecasted labor rate of $30 per hour, and therefore the labor budget is $375,000. Similar calculations could be made for overhead or for other types of materials and labor as well.